You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Siebert, and I, Niels Kostrup-Larsen, are back with this week's edition of the Systematic Investor series, where each week we give you a raw and honest account of what it's like to be a rules-based investor, what news, articles, and market moves caught our attention, and of course where we also attempt to answer your questions. If you're a first-time listener, welcome to the show. We appreciate you taking time out to spend with us, and we aim to do our best to make it worth your while. As usual, let me start by saying good morning to you, Jerry, and good afternoon to you, Moritz.
Good morning, Jerry. Good afternoon, Niels. How are you guys?
Oh, doing well. Good morning. Good afternoon.
Absolutely. Let me sort of quickly talk a little bit about some of the things that caught my eye this week. I mean, of course, we had another busy week, really just after a series of tweets that kind of began with a bit of rage against the Fed chair, Powell. But then it was combined with news from China that plans to add tariffs on additional U.S. goods. And of course, that was a response from President Trump the same day that now the U.S. will hike tariffs on most imports from China as this trade war with Beijing escalates. And I think he also, quote unquote, ordered U.S. companies to find alternatives to China. Now, all of this resulted in a bit of a U-turn for stocks and bonds, sending stocks down a couple of percent for the week. And the U.S. 10-year bond now only 16 basis points from its 2016 low in yield. Energy markets, I guess, came under pressure from these escalations, and gold made a new, fresh 5-year high, around 15.26 an ounce. And we also saw a little bit of a lift in the volatility index. So there seems to be quite a lot to talk about on this weekend's G7 summit in France, where I found out that to protect these 7 leaders, there's going to be about 13,000 police officers. So you wouldn't think, it doesn't seem like they're very welcome down there. But with all of that in mind, Moritz, your sharp views and experiences from the world of trend trading this week. How was that?
Interesting. Well, as you know, I'm on vacation, so I'm just letting time fly by and I don't following the markets that closely. But the portfolio has been marginally up this week. And looking back just from a macro perspective, I think Monday, Tuesday, Wednesday, really there hasn't been that much movement in my portfolio. I mean, bit of an uptick here, a bit of a downtick there, but everybody seems to be await of the Fed announcements. And then on Thursday, actually had a more than 1.5% loss because bonds were selling off. And, as listeners probably know, we're all long the bonds at that point in time. And then that loss was, all made back yesterday on Friday. So that, like I say, it's a marginally positive week, but kind of like range-bound markets with the exception of Thursday and Friday. But it didn't have a lot of interesting moves, really, to be honest.
No, I mean, I agree. I also struggled to find anything particularly interesting about the week as such. We were down, 0.5% or so on the week. Nothing major. Still pretty strong month for us in August. Pretty strong year for sure for 2019. But when I kind of look at the portfolio, it really was a bit of a mixed bag in terms of performance drivers. The weakness in the dollar, especially against the British pound, was kind of the biggest loser within the portfolio this week, followed by Euribor and the euro. And we made the most money for the week really in Australian stocks, in cotton and gold, of course. And sector-wise, as you said, fixed income, and for us also currencies were not doing so well. But then all the commodities were really doing just fine. So all in all, really small movements on our side. No change in the themes, as you alluded to. Still a healthy trend following year so far. What about you, Jerry? And of course, as we always like to ask specifically about things that we don't trade, such as the single stocks, maybe even Bitcoin. I don't know. We haven't heard about your Bitcoin trades recently, so maybe there's some action there.
Bitcoin's pretty quiet. It's trying to stay up close to the highs. Doesn't seem to be, I can't see that it's correlated to the market stocks going up or down or gold. So it's kind of, we'll see. It's active over the weekends in Asia, so it tends to move a lot over the weekend. So we'll see what happens today, but it's hanging in there, not going down, I guess. But yeah, I enjoyed those big moves in gold and silver. Platinum kind of sitting there. I think the dollar still looks pretty good. I'm happy that I'm short some, like a day like yesterday where the dollar went down, but it had a good day against Brazil, South Africa. Israel is hanging in there, Turkey. So I have a mixed bag with the emerging currencies and the traditional currencies, but they're all near their max, moves. So it's nothing to get too excited about. It's sort of earnings seasons, I guess, over here, and we had a big up move in our long Target. It's a big, company over here, so we had a big, huge monster move in Target. So it's kind of funny to, watch these stocks behave differently, and I think it's, it's important to have a sort of a fixed universe and not change out things too much. So. Because you can always find some longs or always find some shorts, and I've done things like that before, and it's been really bad. So in my little fixed universe of equities, which are all sort of names you've probably heard of, it's just not that committed. Even if we went back to new highs in the S&P, I'm probably, just a small long. So it's really fun to sort of see the longs, the shorts, the flats, and what's really going on underneath the market. Versus the S&P or the indexes.
Speaking about exciting things and what is going on, beneath the S&P, do you trade GE by any chance?
No, but it's been a great short, and I follow it. I do have a list of stocks that I like to follow: AT&T, GE, Facebook, things like that are kind of in the news, and but it's been a horrible, wonderful short, of course.
Yeah, no, absolutely. Now, before we jump into Jerry's top tweets, we've got this new feature that we're very excited about, because last week we sent out a challenge to our friend, listener, Sam, and he took up our challenge and left us our first voicemail, which I'll play right now.
Challenge accepted, gentlemen. Sam here from a warm, sunny Wednesday evening in Ann Arbor, Michigan. I've been a fan of the show for about 2 years now, even though Niels has mistakenly given me more praise in the past that I may have been one of the first listeners of the podcast. That isn't quite true. It's been 2 years, but I have listened to all of the content over what has been 5 to 6 years. And given that, I would encourage all of the listeners, both new and old, to listen to all of the content that this podcast has produced going back to the beginning, whether it be the 2-part interviews with all of the managers that started the podcast, the round tables with other industry professionals, and this show, which, congratulations, slightly early on what will be a 1-year anniversary in, I believe, 3 weeks. So thank you for that. I can say that this podcast stands out among all of the other content, whether podcast or books or other type of print, both on systematic trading and investing as well as trend following specifically. It is the premier source, in my opinion, that all of us should be consuming for what is honest, transparent, reliable, and applicable content. On that, have a good evening. I look forward to listening to you guys again after this weekend when episode 50 is posted. Hashtag happy trading, love your system, follow the rules. You can't do any better.
And if you also want to leave us a message, like Sam, that we can share on air, just go to toptradersunplugged.com/voicemail. We would love to hear from you, and to you, Sam. Thanks so much for your kind words and support. Now, Jerry, it may have seemed like a quiet week when we were reviewing the markets, but that may not mean that it was a quiet week in Twitter land, FinTwit land. How was your week when it comes to news, articles, great comments, anything like that?
I mean, I liked them. I thought I did a great job this week. It's all fun, some of the traditional sources that I really, really like, Morgan Housel and Mark, posted some great stuff. I think that fits in with things I'd like to hear about and things I believe in. So they're going to get a lot of the airtime on our podcast. Sam is certainly in number one place as the biggest encourager for me and for our podcast. So I'm looking forward to meeting Sam one of these days. I think even though there's probably nothing more complex than what we do is trying to navigate the world of investments, especially when we want to mix in currencies, commodities, in with the stocks and the bonds and shorts. I don't think there's anything more complex than trying to just understand what's going on. It seems to be almost impossible, and I think it's kind of impossible. But so I guess that draws me and us to confirming our belief that even in something so complex as the markets and the economies, that a simpler way of following these and making money is to follow the trends. And so Morgan Housel had a tweet, an article this week that talked about how evolution has figured out its version of simplification. Get all of the useless crap out of the way. Just give me the few things I need and make them really effective. The question then is why complexity sells in the modern world. Simplicity is the hallmark of truth, but complexity continues to have a morbid attraction. The sore truth is that complexity sells better. And then we'll get into some other tweets that I was just having with this friend of mine here, my friend Mike, not from New York, but Mike from Florida. And he and I were debating. He likes to debate. And I was like in the middle of these tweets, text messages saying, hey, can I post these on Twitter? They were kind of that good. And they got a lot of good response. And it was basically, this cynicism of we don't want to be too forthright about how we trade the markets, back testing and trends, and why am I going to pay you 2 and 20 or 1 and 20 or whatever, anything in 20, if all you're doing is just putting these orders in. And so that's certainly been one of my regrets over the years, is maybe I was too transparent and I'm just following these trends. Don't you just love this? Don't you want to pay me 2 and 20? They're like, no, you're not doing a lot of work. Work seems to be part of it. How much trouble are you taking doing this? And so I think it's, both ideas. I love the simplicity, and I think the better I've gotten over the years, after 35 years of trading, it is really refined down to just the essentials. And then it's hard to sell if trend following is kind of hard to sell sometimes.
Yeah, I mean, complexity is definitely something that we come across a lot, where sometimes our way of trying to explain what we do in a simple way doesn't, as you rightly say, it doesn't sell so well. And it kind of ties in with another podcast recording I did this week, which I may refer to later on as well, with Dr. Daniel Crosby, who has written a book called The Behavioral Investor, which I highly recommend. And in the book, he talks about certain simpler things that people just didn't believe would work. And I think one of the examples he gave was that it was discovered that the way to cure scurvy was simply to get vitamin C. But that the whole community of scientists kind of dismissed that as being, that's just too simple. So in fact, millions of people died before they realized that no, I mean, it really was that simple. That's how you cure the disease. So so there is this. We definitely have this fetish for complexity as human beings. And then the other thing that I guess we also struggle with as humans, which is why we're really not designed to become great investors, is that a lot of things comes counterintuitive to us. And when I think of what we do and things like that, I mean, just the mere fact that we make money from buying high and selling low, I mean, that in itself is completely counterintuitive to most people, because they've all been taught that it's about buying low and selling high. So here we come and say, no, you should buy high and you should sell low, and that's much better. It's kind of an uphill battle from day one when you go out there and you try to promote what we do as trend followers. But anyway, so I think that's very important point that you and Morgan was tweeting about this week. What about you, Moritz?
Yeah, we're back to Occam's razor with that one, right? I think we deserve the fees, the anything in 20 or whatever the fees are, for staying as simple as we can, but not getting simpler. As simple as necessary, but not more. And I think this is a huge part of where the edge is that we're not overcomplicating things. We're not telling the story. We know that from a marketing perspective, right? I mean, I sometimes, when you picture yourself being in front of a client, and instead of what you just said, Niels, is, describing we're buying high, we're selling low, or we're buying high to sell higher, those type of things, they sound so counterintuitive and kind of like, well, really, this strategy works. We know it works, but it doesn't sell that well because it doesn't sound so nice, right? And if instead, we looked at our portfolios of, 70 or whatever markets that you trade, and you just fabricate a story for every position that you have, right? You say, well, I'm long the dollar because of, some macro political blah, blah, blah. And I'm long that stock because of, some value trade, which I figured out doing fundamental analysis for the past 2 months. All of that stuff, I think, would resonate so much, more with clients. And they go, well, that's interesting. He's a real smart guy. Those guys are doing their homework. That's why they have those positions on. But as you know, the truth of the matter is that's not what we do. We just, look at the price and we follow if we can find a trend in it. But yeah, I there's no way that we're going to bend and become storytellers just for the sake of it. Our purpose, and that's what we said repeatedly, is to, stay and be transparent about the way that we trade to the extent that we can, make the system understandable, explainable, explain the benefits, but also, the downsides, that sometimes there are drawdowns, not sometimes, regularly there are drawdowns, and that you have to go with that. But it's, like you say, it's the constant uphill battle for the way we trade.
Yeah, I mean, I'd like to maybe just add something to that. Just a short quote I found in Dr. Crosby's book, and it's on a topic about ego, and how we also, that's the other thing that is really hard to deal with as investors, our own ego. And he goes on to he writes something like, if this time is different is the most expensive phrase in investing, I would like to nominate I don't know as the most overlooked phrase in investing, with I was wrong as a close second. As is so often the case, the usefulness of these beliefs in an investment context is directly proportionate to their behavioral difficulty. Acceptance of uncertainty and a belief in personal fallibility are remunerated precisely because they are so hard to humankind. It is strange to consider that many of the most effective tactics in investing have I don't know at their core. Passive investing, and then I said to him, I would add trend following, is the embodiment of I don't know investing. And I think that sums it up pretty well.
I don't know what that means. I don't know what it's different this time. I hear that a lot, and I think I don't agree with that. I think it is always different. So what do they mean when they say this is a bad thing to say, this time it's different?
I think it's because they always come up with that as an excuse for why they should keep on holding on to their beliefs, right? This time is different. So yeah, the PE ratios can go to 40 and that makes no difference, right? This time is different. Remember that it came, I think, for the first time really around the tech bubble when you could have companies with no earnings and big losses, and yet we still drove the prices up, and people were saying, oh sure, but this time it's different. I think that's what they mean.
Yeah, and I think it is always different. I think this time it is different, and I think that's what trend followers believe. This time it is different. This puts us in trades that are unlikely and crazy, and negative interest rate trades, and shorting crude at 90 to watch it go down to 20. I mean, it never goes down that much. So buy it at 40 and 50 because, but I think from my point of view, it is always different except the breakout. The breakout, you buy the breakout, you sell the breakout, you follow your system. That never changes. But the fundamentals, this is the whole point. The world is crazy. We're profiting off of things that have never happened before, that are unlikely to occur. So I think I've tweeted many times that it's always different. Every single breakout's different. And this is the problem with their analysis is they're relying upon some sort of fundamental analysis based on patterns. And that's why you have people who get dedicated to value, and it doesn't work for such a long time because these ratios and PEs and things that make up value historically with a very limited sample size, they get blown out of the water when crazy things happen like the Fed and negative rates.
No, I think that's true, Jerry. I mean, I think in our case, the way, because at our core, we have this, knowing what you don't know as kind of a philosophy. I think you're right. I think that we can view it as saying, well, it doesn't really matter if it is different or not. It's always different. I think that's a fair point. I think that he writes about it more in the context of the kind of quote unquote traditional, as you say, fundamental investor where, they might end up in weird positions at extreme levels because they, make themselves believe that it's okay. I mean, negative interest rates can go on forever, or, no earnings doesn't mean anything. You can still drive up the price of stocks. But I think that's a fair point. Moritz, you were about to weigh in.
Yeah, I agree with Jerry also, but I think, people say that because they want to support their own believe in a position that they hold. Like, right now, equity markets, they feel like they may be at a high, right? So you say this time is different because you want to continue holding them, maybe in the absence of factual information that, you have. But it's kind of like this, finding an excuse to hold on to a position that you have on in light of maybe, data speaking against it. But yeah, it's always different. I mean, markets are just always different. I mean, that's what we're saying all the time. And what I wanted to say earlier is, I have so much respect for people that give an answer that is, I don't know. In fact, when we interview people, or I interview people who want to work at the firm that I work for, or, other firms, and, you ask them questions, you engage in a conversation, and you get them to a point where you specifically and very concretely ask them about something. And if they reply, I don't know, to me, this is an A+ answer. The I don't know answer is so undervalued, but it's so valuable to, be okay with not knowing, being okay with uncertainty, and not making up an argument and forming an opinion of beliefs and just engaging in a conversation, which then turns out to be blah, 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 blah. Of course, people, all our human beings, we like to tell stories. This is how we engage in conversation. I mean, it would be absolutely awkward to be at a cocktail party, do small talk, and everybody says, I don't know, I don't know, I don't know. But I mean, honestly, sometimes when I reflect back on the day, most of the things I don't know. I mean, 95% of the time I could just say, what, I don't know. I can have an opinion, a hunch. I think this may be true, but really I don't know, right? And we as humans don't do that. And I think it is so undervalued, and people, regard it, and they give it a bad spin. If you're the guy that responds, I don't know, it comes across as, well, maybe he or she is stupid. He just doesn't know anything, and this is not what we as humans want to portray ourselves as. So you come up with something that is just an opinion. And so when you circle this back to trading, I think this is where, we stand steadfast in our approach, because our systems, they don't have an opinion on anything. We have sample size. We don't know. We just, play the odds, but it's kind of like that same thing. The system knows that it doesn't know. It just goes along, and it doesn't, get conflicted in some sort of opinion contest. And this is one of the things, through my entire life, and it continues to the present day, I see this over and over and over again, people forming opinions, mentioning them, but really if you drill them down, right? This then becomes awkward, and you don't want to be like offending people, right? But if you continue to ask why do you think this is, why, at some point they stop and they can't give you the real answer. And that's when you know that they don't know, and that's when they know that they don't know. But if you bring them to the point at the cocktail party, then you're kind of like the outlawed guy, and you'll never be invited back.
Yeah, I think no one wants to allocate to people who don't know, and that's their best answer. And I'm totally in favor, of having a story. I think I'm not against necessarily, because I did the opposite. I never had a story, and I stood on the mountaintop and said, I don't have a story. And so I'll say one thing. I think a lot of these really large managers, they use trend following, and they have a story as well. And that's their story. And they do not have a trend following story. So from a business point of view, I think I'm not against necessarily doing it the opposite of the way that I did it. It seems to work out better if you do have a story, even if I don't think you should rely on that story, but you should rely upon the trends. And I think not knowing is good. It reminds me of a story I've told many times about having an opinion and then someone saying, so you're short the S&P? I'm like, God, no, I'm long. It's in a big uptrend. So it's okay not to know, but then to say, but I am long the bonds. You don't know, but you're long the bonds with those massive profits. Yeah, because I don't need to know why, or I didn't know that it was going to be a great trade. The most important decision of the year is, did you allocate to the bonds? Did you have a permanent allocation, regardless of, well, they're all awfully high. They're all sort of expensive. That was out a lot this week from AQR. Bonds are frickin' expensive. I don't even know what that means, but I guess negative rates, kind of could be turned into something that's expensive. But did you allocate? Did you do the trade? And have you done nothing since then? Since the beginning of the year when you put the trade on? There's your genius. There's your. I do know that. That is what I do know, is that I need to follow that system and just kind of close my eyes when it doesn't make a lot of sense, because they could be juicy trades when they don't make a lot of sense.
I love it when you say you don't have a story. I think you have one of the best stories in the world, certainly in our space. The turtle story is, doesn't come much better than that, Jerry. So there we are.
I like the point. I can see it at the cocktail party saying, well, it's so crazy to own bonds at negative rates, right? And who in their right mind would ever do this? And then they say, well, so you must be short and you're not touching them. And they say, no, I'm fully long. Like,
that's right.
I've bet the range on it.
Exactly. I'm fully long, and I'm very happy. And that has to be the second part. I don't know, but I'm making a lot of money. And then you'll be the center of attention for that cocktail party.
Exactly. Free drinks.
Yeah. Another one kind of following up, and this is like right in the trend following wheelhouse. We are not in a normal world, nor is it likely to become normal in the near future. Investors have to accept continuing irrationality and be bond buyers, or potentially miss what could be a great fixed income opportunity. It's from Mark. He's a very reliable source. He writes a lot of great things on his blog. I can't pronounce his last name, but I would if I could. But yeah, I don't think the world can ever be trusted to be normal. The markets are never normal. It's always irrational. It's always going to be somewhat of a surprise. You're going to get these great opportunities just by following these trends.
Yeah. Any thoughts on that, Moritz? Obviously it ties in with the previous one, right?
Yeah, fully agree. I don't think there's much that I can add to that. That's just a good summary of market behavior. They are never normal, and we just try to find the bits in that distribution which have trends and then follow that.
Another thing that I've noticed over the years, especially on Twitter, is that the people who are the most committed to indexing or trend following, they frequently tweet about the merits of being counter trend. in the stock market. So the people who would advocate just buy and hold with passive indexes are always tweeting something about the market's going to crash. I mean, I don't get that. And the trend followers as well, which I can kind of see because they have a bad idea of we tend to make money when stocks go down. I am long stocks. It is a trend. I cannot close my eyes that it is the stocks. So I must kind of badmouth or hope that this trend is going to reverse, even though I'm a trend follower. And this one guy tweeted, my favorite is that you get 80 likes on bullish tweets and 400 on bearish ones. And I commented, and they professed to just be following the trends. And all of their other tweets, I'm just following the trends. But they seem to be very happy. I mean, can you imagine like a tweet about palladium or emissions or gold? I'm really rooting against my own position that it goes down. No, of course not. But there's just some tendency to turn your back on your true belief when it comes to the stock market. Stocks are so crazy. What we've been fed a lifetime about the stock market is usually so counter to what we do in what we feel in all the other markets.
Yeah, I mean, very true. I'm not sure I can add a lot to that. It's how it's always been, so to speak. And maybe that's the consistency, right? And maybe this is the whole point, as you mentioned before. These things, this is how it's always been. So it goes back to the point, why does trend following work? Well, because what we do is we explore kind of the weaknesses of human beings, and human beings and human behavior is very unlikely to change in any meaningful way. And that's what we continue to benefit from, so to speak. Yeah.
My favorite or most popular tweet of the week was this. Expecting stock trend following to outperform in a bull market and protect in a bear market is like thinking you can stop paying the house insurance but still get a payoff when disaster strikes. There's a cost to trend following, and the drawdown graph shows it's worth paying. And of course, we know that that's true in all the different markets. Buy and hold, we're getting out at the lows, we're getting in at the highs, and sometimes we just get whipsawed all around, especially in the stock market. These crashes have a tendency the past few times to reverse as soon as we get out of all of our longs and maybe even go short. And then, so that's kind of the cost of where the market continues to go higher for many, many years, and we're trading individual names and getting out and having to get back in. And this is sort of the cost of, I've read articles over the years of these animals that just get a little whiff of danger and they scurry. They have these ways of feeling that danger is coming, and 90% of the time there is no danger. And so it's a total overreaction. But they survive and they live. And this is kind of what we do. We are taking our small loss or reversing positions or getting out and going flat, and the market goes right back to the highs. We have to put the trade right back on. And our system told us, hey, now's the time. It wasn't. Nothing really happened. So I think survival is paramount for people who use trend and diversify into things other than stocks and do shorts. But there is, a premium to be paid and there's a cost to be paid. But even though we win in the end, it is we make more money by following these trends and being more diversified.
Yeah, I mean, I think it's interesting you mentioned this cost of being in business, meaning, if you invest with a trend follower, there's definitely going to be periods of time where it's going to cost you money, but it doesn't mean that you should, as to put it in the analogy you mentioned, shouldn't mean you drop your insurance just because it costs you money, because one day you're going to claim on it. But it reminds me of sort of conversations or discussions that I've had over the years, not so much recently, but there's been a lot of people who would always counter that and say, well, I could just buy puts, right? And just continue to buy puts every year, and that's kind of the same thing. And I'm saying, no, it's not the same thing. First of all, I think there is a fund that actually tracks what happens if you buy for like 5% out of the money puts on a continued basis, and that fund alone significantly underperforms the benchmarks that it's up against, and I think relative to the S&P, et cetera, and then compared to the fact that we as trend followers, we do have evidence that although we're not selling ourselves as a hedge to, or we shouldn't sell ourselves as a hedge to equities, historically we've certainly demonstrated the ability to make money when equities go down, but we've also been able to demonstrate that we make money over time. So it's not an insurance that really ends up costing you money. On the contrary. Yet sometimes people just still prefer and say, well, I still think it's a better idea for me just to buy puts. And so it's hard to understand sometimes the logic with these decisions.
I think the best insurance that I've come across in the markets is my initial stop loss. That is the most valuable insurance to me. I know, I put a position on, and I know that, if it doesn't work out the way I want it to work out, then, I'll be getting out relatively quickly. I'll take the small loss before it becomes a devastatingly large loss. That is my initial insurance, and I will never put a position on without that. So it's always insured. And every once in a while, it just starts to run the way that I want it to run. And, it pays for the losses and then some. So this to me is the insurance. Of course, it's, always tough to be in those continued and long, deep drawdowns, and kind of like, when you think about, well, I've paid all the insurance all that time, and, it brought me to where I am now, which is in that drawdown, so I'm going to continue to do that. It's exactly what you have to continue to do, right? It's exactly what you need to do at that point in time, is to continue to put the positions on, to still be with that mind that allows you to follow your system, put the position on, and pay the insurance again if you want to come out of that drawdown.
That's the key. Keep doing the same thing over and over.
Yes.
Not doing the same thing over and over, not being 100% disciplined, creeps into your approach, your systems, your in a sort of a this time it's different way. This time it's different because rates are so low, I won't buy the breakout. This sort of thinking can creep in, and you make it a rule. Oh my God. Well, if it's a rule, who can argue with that? Well, I'll argue with it, because even if this is what the modern CTA faces, if you just do it discretionary, like I used to do in 1984, just not going to do the trade. But now that it's all written in code and we have all these rules, it's rules-based investing. Well, there you go. Who's going to argue with that? Well, if it's a bad rule, if it's a rule that prevents you from buying the upside breakout because you have a filter that filters you out of a big trend, that's a bad rule. So it's not about rules necessarily. It's about having the right rules and not trying to be so fine-tuned. If I use this rule, my win percentage will go from 40% to 41%. And historically, looking at the bonds, it's been a positive rule. Bad, bad, bad. Oh, those are such bad statements. Don't look at just the bonds. Look at how, and don't focus on your win rate going from 40% to 42%. Focus on not missing these mega trends that have never happened before. Only because you kept buying the breakout, selling the breakout over and over and over again. It's so mandatory. If you don't do that, you won't get any the amount of profit from your system that you should.
Yeah, and I think from an investor point of view, it goes back to this point about trying to be too clever about making allocations to any strategy, including ours, because certainly if you miss the first half of this year, if you miss the month of August or whatever it might be that looks good so far, it has a huge impact on performance. So making something you truly believe in a core allocation and doing nothing is doing something, right? Just leave it there for as long as you possibly can. That's also something that we as humans can find difficult, because we think we have to do something to be quote unquote an active allocator. But no, you just leave it and let time do its work. Yeah, super important. What else did you find in social media this week, Jerry? Otherwise, I've got a small article we can talk about. We've got questions, of course, as well. We can dive into. It's
Okay, so let's end with this one. I like this one. This is from Mark again, and he's had listed a couple of quotes from someone he liked, and I like these quotes as well. In God we trust, all others bring data. Without data, you're just another person with an opinion. If you cannot describe what you are doing as a process, you don't know what you are doing. Bring your data, not your feelings. Then I sort of ended it by saying, small amounts of data are just the same. They're just as bad as experience, hunches, feelings. So once again, I think can't just say I'm bringing data, because everyone has data. The last 5 times this happened, we just have so much data, so many trades, so many over lots of years and lots of different markets, longs and shorts, that when you get away from this sort of transactional trend following that produces buys, sells, that's the kind of data you need. Anecdotal data is still not going to help very much. Small sample size, I think, is the bane of all of our existence, and we're kind of all susceptible to being drawn into it.
Yeah, I mean, not much to argue there. Yeah.
Fully agreed on that one.
Definitely. Well, one of the articles that I picked up this week was just a little bit about some of the flows that hedge funds, including managed futures that we belong to, had seen so far in 2018 and so far in 2019 up until the end of July. I think this comes from a report that was published this week, and this article featured in the Financial Times. And it's quite extraordinary because, in both years, there are some strategies, long short equity probably takes the lead in terms of outflows, net outflows. But I mean, managed futures is up there as well, along with multi-strategy, and this year also global macro. And to me, it's kind of interesting. I'm not so sure about long short equity. I don't really know much about that. But I mean, you think about certainly managed futures and global macro. I mean, I think it's the world. We're kind of been in a world, but I think we're getting into a world much more where there are a lot of macro themes that is playing out in front of us. So I find it interesting to see that investors are kind of leaving those kind of strategies in favor of something like there's a mortgage-backed securities I saw had some net inflows this year. But overall, I mean, I think most of the money are actually net flowing out of hedge funds and into just cheap replicators and passive investing. So it's interesting to see some of these moves. I don't know what you see on your side and the people you speak to, but it certainly seems to be a tough year to raise assets for these kind of strategies.
I mean, we just keep adding to our list of possible reasons that our strategy is going to make a big, huge comeback, and this is just another thing to add. Clients are probably the worst timers and doing the exact opposite, from making a permanent allocation that you talked about to great strategies that add diversification and risk control without sacrificing profit. So once again, another good example. It's an article in Bloomberg. It's an article in something else. And now it's probably one of the best periods ever reducing their allocation. So probably a good sign, but we've been keeping this list for a while. So hopefully this is the beginning, as you said earlier, that of getting back to sort of more normal markets where the trends and not just long only stocks.
All right, let's jump into some of the questions. The first one is it's from George, our friend George, who helps us out and helps everyone out really by making these wonderful minute markers and quotes that we get from each episode. So we appreciate George very much. George wanted us to talk a little bit about this topic or issue that we sometimes refer to, and that is and I'm just paraphrasing the issue, and the issue is really we don't want to discourage people to become trend followers. We're here to help. We're here to share our experience and help people move forward in that path. But we also have to, be honest and say that it's a tough space to be in, and not just from there's a lot of hard work that goes into coming up with the right models and testing and all of that stuff. But also from the fact that it can be very hard to implement successfully if you don't have enough capital, because one of the key ingredients in trend following is diversification. So George kind of wanted us to talk about this topic, whether it's better for investors or smaller investors, up to what size, and love to hear your thoughts about it. When is it better to find a few managers and invest with them? When is it better to pursue the design and the trying to get a trend following portfolio up and running? So I'll send it over to you guys to begin with to discuss this issue that George raised.
By the way, thanks, George, for this. I think this is an excellent question, and we were exchanging thoughts on this via email the past couple of days, and I guess we all have some different opinions on that. I thought about it a bit, and so here's my take on that. I think you can run a trend following strategy with, $1 to $2 million in equity. I mean, it's definitely possible. It may be possible to do it with less. Now, this is kind of like against saying, you need a fully diversified portfolio, 70, 80 markets, et cetera, futures only, all of that type of stuff, right? Well, if you say you had $1 million, I think you can get an acceptable level of diversification with 20, 25, 30 markets. There's nobody saying that you absolutely must trade more than 70 markets. I'm saying it's better to trade 70 than 20, but you can trade a trend following system with 20 different markets or 25 different markets. And if you have $1 million, then you may end up with relatively high margin to equity and therefore relatively high volatility. So you may be in for some volatile ride with your portfolio. But I think it's doable. It's not impossible to do, right? Now, the more money you have, if you have 2 million, if you have 3 million, then the more diversified you can get and the more you can control that volatility. But there's another point that I want to make on that. And, there's CTAs out there that run systems with 2 million and they're just doing fine. They're running at 30, 35 vol. And they're transparent about the way they trade and the markets they trade, and that it is a highly volatile system. Now, the other thing I want to say is, if it really depends on what your objective here is. Do you enjoy trading? Do you like putting orders in, following the market, staying close to the markets, kind of like being in the driving seat for your own system, being a part of this market and kind of like, going head to head with guys out there? Is it making money with the best possible risk adjusted returns? What is it? And there's, sometimes, say you're at a certain point, you're of a younger age, say, and you have a bit of money and you want to make some really a bigger change to your account. Say you had 3, 4, 500,000 or something like that, right? I mean, how are you going to turn this amount of money into generational wealth or whatever that, it's but a really bigger pile of money? 10 million, 20 million, whatever it is, right? 30 million that allows you to retire, or 100 million, right? If you have 500,000 and you invest that in a CTA that makes an average rate of return of 10% per year, then that's just never going to happen, right? Then you'll be compounding at 10% with your 500,000 portfolio for the next 30, 40 years, but it's never going to be life-changing in the way that, maybe people dream about it. So I think there is a trade-off that I don't feel is discussed very often in trading, which is if you really want to shoot the lights out and you want to make a lot of money, and if this is what your objective is, then at some point you will probably have to take large risks. You will need to take that large risk and just go for it. Now, this may, when I say this now after our, 50th recording, it may sound irresponsible, but it may be a very responsible decision for you to do this, but you have to be aware of the consequences, right? You have to go for it. You have to press the trades, put them on. There's going to be lots of volatility. There's a high chance that, your account won't survive the ride, but there's also a chance that you will get to your objective, which is creating a lot of money, earning a lot of money. And if you can, do this, there's also a lot of luck involved, I guess, then you can dial it down and, kind of like trade in a more risk-controlled way. But really, again, if you have less than $1 million and you really want to make a lot of money in the markets, it's really the only way I can see is with risk and volatility, and you have to dial it up. And this, I guess the younger you are, the sooner you do it, the better it is. But yeah, so those are my 2 cents on that. I'd like to hear your thoughts.
Yeah, I think that was great. It was fantastic. I think that, and so when you hear this, and then you lose all your money, you're going to say, oh, I didn't really hear if Moritz mentioned that part, that I had a good chance of losing all my money. Well, he did mention it, so don't forget that part, because that's the big part. You're going to start small. You're going to make some compromises and some choices to make a lot of money. It sounds like you should probably learn how to play blackjack. Maybe that's safer. I don't know, but I think I did all of that, and I did make it. I did survive, and but I think the one thing that's even harder now than it was a long time ago is that worked for me because shorter term exits were okay. That was when the shorter term exit strategies were profitable. But now we've all sort of we've all on record here as saying that we trade longer term and the markets are choppy. And if you get out at the 2-week low to get out and take that profit, you may have to buy it back, and it may be a third of the way up. We got a long ways to go in some of these trends, and the bonds themselves, have they hit a 2-week low or a 3-week low in the past year? Probably. So I think that really, but leverage has got to be key. You got to really jack up the leverage. You've got to get lucky on your choices of markets, sit through the volatile drawdowns, try to figure out a way to protect your capital and not lose it all. Or when you do lose it all, you just get more capital and try again. But I really don't know how to get around this idea that in the long run, the odds are not in your favor of shorter term strategies, which really help trying to turn $2,000 into millions.
Yeah, I think a lot of good stuff from both of you there. I actually had an email from a listener this week, kind of dealing with the same issue. Someone who's been doing it for a long time, he'll remain nameless, but someone who's been doing this for a long time, done everything right, really studied, followed mentors, systematized, taken every single trade according to him, and saw his account grow from 30,000 to 1 million, I think, at least, which is fantastic. Wow, that's amazing. But in the last few years, that account has dropped again by 60, 70, 80%. So that's the hard part, I find. And so I completely agree with what Moritz said, that if you want to really make a lot of money from being a trend follower, without building a business and manage other people's money, you have to take quite large bets, but large bets also means big drawdowns. And you might stumble up the courage and say, well, this is okay, I'm down 60, 70%. but I believe in my system. And I'll continue, and that's fine. But I think if you want to make a lot of money from this, you have to. I think you have to build a business around your strategy, so that you can manage more money in the same strategy. And once you take that decision, you run into two problems. One, you're now competing with all the greatest trend followers out there that you can find. And two, one of the things that is really, really hard and completely underestimated about what we do is how difficult it is to grow a client base within this world. And so I think you face some really big challenges. And this is why, and this is my personal opinion, that unless you have enough money and you really want to make a business out of it, I think that most of the time the best answer is to find a few really good trend followers, invest with them, and enjoy life, or have more time to enjoy life. But it doesn't mean that you can't study trend following, and because it allows you to ask better questions of the managers you invest with. It doesn't mean you can't, really become, very, very knowledgeable about it, and so on and so forth. But I think the bar today is high. I think firms like the ones we represent and many of our peers are super professional, have evolved, built strong businesses from an infrastructure point of view to their research capabilities. And we've made a lot of mistakes, all of us, and we've learned from them, which is key. I think that's probably the only way to really evolve, is to make mistakes. And that's hard to suddenly, you can't study mistakes, and well, you can study some, but you can't, it takes time. And so you have to, at least if you go down that path, be in for it for the long run, I would say. So I think that the amount, back to George's initial question, I think the amount before you decide to go on your own rather than finding external managers who can do well for you, I think that the amount is a little bit higher than what, I know Moritz said that it can be done, and I agree with that. Of course you can trade a trend following portfolio with a couple of $1 million. Of course you can.
Maybe it's stocks only. Maybe it's stocks and some ETFs. You're having fun. You're practicing. It's a diversion. It's like fantasy football. And then I have my Fidelity account with a few stocks that I trend follow. I mean, I wouldn't want to discourage people from doing it, but I do think that over the years when I've tried to hire people or meet with people and say, okay, maybe you're not, maybe how about a position as, in marketing or something else? No. I have to be a trader. I have to be a trader one of these days. I'm going to learn from you and be a trader and do research. It's like their golf game. Like you don't have to be good at golf. You just want to get out there and enjoy yourself. And no one can play golf for you, and you can't kind of like have fun if someone is a better player is playing for you. But managing money and your assets is not golf. It's a big downside if you don't get it correct. And so I think that you get confused. But trading is fun. We all want to do it, and I don't want to be on the record as kicking people out of our little club, because regardless of how much money you have, you're going to have a good time. Just be careful, and probably it's best for most people just to stick to their stock account where there is no leverage, and they can still enjoy the markets and the trends and a podcast like this where they feel kind of like they're part of something,
So good point there. I mean, on the ETPs, the exchange traded products, that's exactly right. I mean, you can buy them on margin. It's possible to trade a diversified trend following strategy using ETFs and stocks, right? I mean, there's ETFs on bonds, there's ETFs or ETCs, there's, which are the ones on the commodities. You can buy gold on margin, and then it doesn't have to be all futures contracts. You can still buy the euro-dollar futures contract because that doesn't cost a lot of initial margin to hold, right? But you may not buy crude oil or sell crude oil futures and use an ETP instead with, smaller size. So I think it's possible. And what Jerry just said is, I think, really important, which is the learning curve, right? You're doing this and it gets you into the driver's seat. You're becoming responsible for that performance. You become responsible for your account and how you trade it. And I think the amount of knowledge that you will get from that by doing it yourself is second to none. It's really valuable. And one other point I wanted to make is that probably our listeners, a lot of them have probably read the Market Wizard books, and there's the portraits of Etsy Coda and Michael Marcus and all those legends in there who reportedly turned $30,000 into a couple of tens or hundreds of millions. So you have those images at the front of your mind, saying like, well, those guys, how did they do it? And I want to do the same thing. Well, like Jerry said, this time is different. It was different back then. Different types of strategies used to work. I don't want to say it's been easier. I think that would be wrong. It's just the systems that worked were different. Today you have to apply different tools. Maybe there's something very easy out there that we haven't discovered, which is easy today, which didn't exist back then, which you could, strategy that you could trade and turn $30,000 into 10 million or 80 million. But again, let me say this, it depends on what your life circumstances are and what I think your objectives are with this trading business. Do you have a job? You have a family? You just, want to, have a great career at the employer you work for, and you do, trading as a kind of like, more like an investor? Okay, yeah, allocate to a bunch of CTAs, allocate, across different strategies, build a diversified portfolio, and just compound the money, compound your savings while you're, keeping, making a great career. And this may be a fantastic life for many people. I'm not saying there's anything wrong with that. But if your objective is to shoot the lights out and, buy the $10 million property in the Bahamas, well, you either need to have a very good job, or if you want to do it with trading, there's just no way. You have to take the risk and dial it up at some point and take your shot at that.
Good stuff, guys. Yeah.
Very few wealthy people make their money by investing. They make their money in their business, and then they start investing conservatively for their later years. And people in the investment business, they don't make money risking their own capital at these high leverage rates. They raise a lot of assets, and then they invest their money properly. But there has been a few people. I just think luck plays a big role in it. How many people in Market Wizards are as you described, and then how many people equally nice and smart just never made it to Market Wizards because they didn't have that luck. I wouldn't discount the luck thing. So I try to say, oh well, if you can find a system that's kind of shorter term, using leverage, but I think maybe luck plays as big a role as anything.
Well, there's one thing to look forward to. Jack Schwager is a friend of mine. Probably you guys know him too, but he's going to write another book on the undiscovered, unknown market wizards. He's got this business called fundseeder.com, onto which you can upload your performance data. So he's currently, if people are listening and they're trading and they have a great track record, he's currently looking for trading track records, live audited trading track records with, outstanding risk-adjusted returns, not by hedge funds, not by brand name hedge funds, but from unknown, undiscovered guys, right? So if you have a great trading strategy that has produced a lot of money, so maybe there are those guys out there that have turned 30,000 into 10 million, right? I mean, they're not putting that into the newspaper for us to read, but maybe we will find and read about those people in the next Market Wizards book. And I'm actually looking forward to that, because I think when what I said earlier, it's back then it probably hasn't been easier. I mean, I haven't been around. There probably are strategies today that can be traded in a way to turn 30,000 into 10 million. It's just that the three of us don't know about them.
Yes, well, with all that discouragement, if there still are people who want to, make it, we still have 2 or 3 spots left on our live event in New York. So I don't want to discourage everyone there, and I actually hope that.
Neither do I.
Yeah, exactly. So I actually hope that you're gonna take us up and reach out and make sure you become part of this little group. I think it's gonna be lots of fun, and hopefully by addressing your specific challenges when it comes to trend following, hopefully we can help you avoid a lot of the mistakes we've made, but also, more importantly, really create some breakthroughs for you in your own trading. But thanks, George, for that question. We appreciate it. The last two questions for today both comes from James. James, who has sent us his questions before. The first one is, could you cover what you all believe to be the main aspects of the strategy which are misunderstood, and why? I'd also like to hear your answers to the question that investors ought to be asking. Who wants to jump into that one? Well, I don't mind jumping into some of this, and we can make it a quite an open discussion. I think when it comes to questions that investors ought to be asking, I remember that when I started the podcast many years ago, this was one of the questions that I always asked my guests. You know, what should investors be asking? Because a lot of the questions that investors ask, at least back then, came from more or less the same due diligence questionnaires that people were adopting that format. So you would get the same questions every time, and it kind of became a little bit monotone and boring. But I do think that one question that doesn't get asked very much, which I think is a good one, is an important one, is to ask managers about the research that didn't pan out. And kind of the graveyard of their research process, because I do think that we do learn things, and there's obviously reasons why certain things doesn't get implemented in our strategy. But I think most investors tend to ask about the few things that did make it into the portfolio, instead of asking about a lot more things that didn't make the cut, and but it doesn't mean that it wasn't valuable, in my opinion. So I think that's something where you could dig a little bit deeper as an investor when you talk to a manager, and who knows, I mean, some of the things that didn't pan out at the time in terms of the research may come back later on, and something that you, maybe with someone joining you with a different set of eyes looking at the same issue, might find a solution to. So I think in that sense, that's important as well. Let me leave it there and hear what you guys are thinking about these questions.
Yeah, I think the two most important things to me that I would ask someone or try to get into a potential client's head is just the idea that stocks are not superior, and it's really risky to be long stocks only, and that there's no reason and there's no compromise of adding all these other markets. But if I'm talking to a systematic trader or trend following trader, I think that the most important question is describe to me how you count your sample size and what is your sample size. So I think nothing is more important than understanding the back test and how it kind of works, since this is what you're going to do in the future. Nothing is more important than understanding that you have a legitimate back test, and it can't be legitimate unless it's, the proper counting of the trades and the sample size. So I think that, to me, is by far and away the most important.
What are your thoughts, Mart?
To me, I mean, this has been a two-part question. What is misunderstood about the strategy? Probably a million things. Crisis alpha. Is there really crisis alpha, or is there not? I mean, let's keep that aside. But I think the more interesting question is, what would you ask the manager? What would you expect? And to me, like when I speak to other CTAs or asset managers, I want to hear about their failures. and how they came to where they are today, and what roadblocks they had to overcome, and how many of them, and how many holes they had to kind of like, crawl out of repeatedly, and how painful that has been. I have not yet met a trader that has just from the get-go been a superstar without the scars of this business. And I think those are the important ones that I want to hear off and about is like, how painful has that been? Where have you kind of like tipped over and why? And how have you corrected that? And what have you learned from that? This is extremely important to me to hear.
Yeah, I wanted to comment on the research thing. I have a different take on that, on the research. And I would love to tell people of my failures about research, because the failures are anything other than trend following doesn't work. So I've even told you about some things we looked into that were kind of dubious, like let's say taking profits or volatility resizing, which are going to violate sample size. And so the research people would come back to me and say, yeah, it's kind of bogus to take a profit after, a certain ATR move or to vol target. But if you just waited to like 1 week lower of the price or have it cross the 10-day moving average, it becomes a lot better. So bad ideas, you throw trend following on top of it, it makes it a little bit better. And then another thing is that all of the trend following systems make about the same amount of money. So we didn't choose all of them. We chose kind of a group that were all medium to long term. But so the failures are the things that were not trend following. And then all the trend following stuff worked really well. We just had to make some choices on which ones to take. So I'm always laugh and giggle when I hear about, what about all the research that didn't work out? Well, it was all the things that I knew better not to do because it wasn't based in trend following.
Yeah, I want to comment just on two more things on these topics. One is I think in terms of the biggest misunderstanding that I can think of right now this minute is probably this thing about people believing that volatility equals risk. I think that's something that I think most people really truly believe in. But it's just not the case, and there's a lot of evidence to suggest that. And I think, again, I go back to this wonderful phrase that David Drews came up with, where he basically found that the most robust systems are the most volatile. And I can't remember exactly how he phrased it, but I think it's quite interesting. But I also want to just quickly comment on a personal note, what Moritz said, because I think that the point about the scars of a manager is truly important, and I have a really personal example in my family of that, since my son a few years ago had a cardiac arrest, so essentially died for a few minutes, but he survived. But of course, every time he's take his t-shirts off, you see the scar, right? But I think what is always important to tell someone like that, but also to when we correlate it back to managers, is that the scar is nothing to be embarrassed about, because the scar shows you that you survived. And that's what it's all about. And in our business, we're sometimes maybe a little bit embarrassed to talk about the 50% drawdown we had 15 years ago. But no, we shouldn't. I mean, it's a good thing that we can show it, but and that we're still here. So I like that analogy that Moritz brought up.
And personally, I think unfortunately my biggest scars were just when I didn't follow the systems. So I agree that the 50% drawdown, or I lost 7% in one day back in the 90s because of the British election, and I probably made money that month. As bad as I felt that particular day at 3 or 4 o'clock in the morning, Eastern time, I had to, do those trades. And that scar is not nearly as bad. I'm sure clients think that's like the worst scar ever. The worst one ever is the ones where I overthought, missed the trade, didn't stay disciplined. So I think in a unique way, that's, I think, scars we should be ashamed of, and that they remind us no one can predict what these markets are going to do, and your system is your best idea.
I agree with that. It's more like the minor scars, like you say, Jerry. The same is true for me, like not doing the trades that you're supposed to do, or trying to outsmart the system, putting positions on that have no purpose in the portfolio because you're all over your head and you think you know something better than anybody else, and you put a position on that has no place in your portfolio because of whatever reason. You just believe it's going to work, but it doesn't then work, and it loses you money. And that is kind of like a mini scar. It doesn't lose you, the 7 or 10%, maybe it loses you 1% or something like that, but still stupid trade, right? And I think it's, we've all done that. And, in the earlier days, there has been much, much more of that bad behavior because nobody, I think, starts out as a 100% systematic trader. I think most people come to the markets in kind of like an active, alpha-oriented, I'm just going to outsmart other people out there type of way. For the three of us, it turned into long-term trend following. There are other branches of our business. They go different directions, but I think they all start with, or most of them start in a not 100% disciplined, systematic way. And that gives you the scars. Now, the most important thing about those mini scars is that you learn from the experience and you take the right conclusions from it. So you do the bad trade, you do the stupid trade, you lose money. Okay, so something has to now happen and click in your brain that you're not going to do it over and over and over again, right? You're very likely you're going to do it a second time, a third time, right? Because kind of like, it hasn't worked out once. Sample size of 1, do it again, right? But over time, those scars, they will become so many that you will hopefully start to realize, well, I should not be doing that. I should be more disciplined, follow the system, and not try to do anything except.
I do think, though, that trend following is more susceptible than any other strategy to create when the lack of discipline or the lack of doing the trade is going to be way more than a few percent. It's massive because we're just going to have this tendency to screw up the big trade and the bond trade. This is not just a couple of percent if you didn't do the bonds, if you had the filter that overrides the bonds, or if you get out too quickly on a big trend. So I do think because we're relying upon these outliers, you've got to handle these things perfectly, in the same way that you handle all the other trades that, it's easy. The current trades we have on, they're easy to handle when they're small winners or small losers. It's like you just get nervous and you want to get out quicker, or you want to maybe not do the trade in the same way because of all the pressure and what you're hearing. But I do think trend following, you're going to have some, if you don't follow the systems, you're going to probably not follow them in those mega trades where you need to put it on and sit back and leave it alone until the exit criteria gets hit. And then I do also love that Drew's quote, and I remember it a little bit differently in that I've never really understood exactly what he meant, but I think it was along the lines of the big drawdowns will signify that your systems are very robust. And I tried over the years to understand what the heck this thing means. And I come to my own conclusion that what he is, I think, saying is because you have a system that had the big drawdowns, it was evidence that you were only doing the system trades. You didn't interject. You didn't have an overlay. You didn't classify it as money management. And so you overrode the system to vol target or to reduce the position. No, you just left it alone. And when you're following your system, you're going to have big drawdowns because the exits were not optimized, and the longer term stuff works over time, but it on any individual trade it kind of sucks. And so I thought I think that's what it means. That's what it means to me, and I really like that whole idea that if you're protecting capital apart from your normal system entries and exits, you won't have the drawdowns, but you won't have the reliable profits either.
Yeah, and I think you can go further thinking about that piece that David wrote. I think the whole point was actually that you will have these big drawdowns because you didn't optimize your system in general. I mean, you weren't trying to find the best system. Like we often say, good enough is good enough. Don't try to overthink it and be too clever. So you're going to have big drawdowns. You're going to have lots of volatility, but it's actually a good sign because it means that, it's going to have more robustness over time. So I think that's exactly right. Now I'm going to quickly jump to the last two questions. Also from James, just a few comments, if you would. One of them is just whether or not you look at volume for when you get the breakouts, or is it just price buying the high? Is that good enough, or do you want it to be supported by volume? And the other question is to do with correlation, whether or not there are any rules on your side that suggest that you should be reducing things or exiting if there is a pickup in correlation. He says at the end, there must typically be quite a lot of noise, which may give false signals, etc., etc. So just those kind of quick comments. I see you are ready to go on that, Moritz.
Good question and quick answers. So I do look at volume, but not at the time of the breakout. I look at volume to determine whether markets that I trade are liquid enough for me to trade them. And that really is the only thing. So I'm not looking at a volume-based pattern to take trades or exit trades. And correlations, I do monitor correlations, but they are not an active ingredient in my trading system. So if I have two positions on and they used to be uncorrelated, but they become more correlated during the time of the trade, then that is not going to impact my position size.
Yes. Before you do when you set up the portfolio, are all the markets have sufficient liquidity? And then take into consideration the correlations the best you can, knowing that they're going to kind of ebb and flow, and setting up your portfolio weightings. So going to trade cotton, coffee, cocoa, sugar with 1 unit each, but not crude, heating oil, unleaded with 1 unit each, because they're kind of very correlated. So a third of a unit each, 50% unit each. Yeah, it's something like that. I know there's disagreement on that, but yeah, some of these markets are 90% correlated almost all the time, and then they're not. So what are you going to do? It's a tough choice.
Yeah, I mean, I think those are very valid points. On our side, we probably do it a little bit differently because we do look at correlations on an ongoing basis, more on a portfolio risk management level. But I think to keep things simple, I think what Jerry and Moritz said is perfectly valid. Now, let me quickly run through performance so far this month, this year, and then if you can think of anything else you want to bring up, let's do that before we close. Beta 50 index, I think yes. So this, as usual, this is the numbers as of Thursday evening. So I think yesterday, Friday, was probably a mixed to slightly positive day for most managers. It really depends, again, whether your positions on some of the bigger sectors right now. But anyways, Beta 50 index up 1.97 for the month, up 10.64 for the year. SocGen CTA index up 1.44 for the month, up 10.07 for the year. The trend index, which is more aligned to our style, up 3.5 for the month and up 16.58 for the year. SocGen short-term traders index up about 1.07%, up 2.3% for the year. And the Bridge alternatives index up 4.68 for the month and up 14.26 for the year. Any final thoughts as we slowly start to wrap up our conversation this week?
I enjoyed it. I think it was a good session. We had some good talks on how much money you need to trade and what your objectives are in trading. But let me conclude with happy trading wherever you are. Enjoy the summer.
Yeah, fun. Now keep those questions coming. I want to stay in touch with what everyone's thinking and help as much as we can.
Absolutely. So remember, if you want our help live in New York, small setting, October 26, 27, do go to toptradersunplugged.com/live or send us an email. There's still 2 or 3 spots left. We would love to have you all there. And if you want to give something back to the podcast, so to speak, all we ask for is that you share it with your friends, like-minded, hopefully. And 1 share would be great. So with that said, from Jerry, Moritz, and me, thanks so much for spending part of your day with us. We are grateful for your support, and we can't wait to be back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us.